Hi there, Mike Brady with Generosity Wealth Management, and today I want to talk about a little bit of a review on 2011. I'm going to spend most of my time talking about the current situation right now, and maybe do a little bit of a thinking about 2012 and what the future might hold. 2011 was a real volatile year. I mean, frankly, when we look back at year upon year, we could always say that it's very volatile. I'm going to show a graph in a minute or two that actually shows, we kind of forget about it, but many years have large declines intra-year. So 2011, I'm going to throw this box up there. This is kind of a style box from valued, blend, growth, and large and mid and small cap. And by the way, I've got lots of disclosures at the end of this video, so I highly encourage you to read those disclosures about the unmanaged stock indexes. But what you'll see is, in general, the U.S. market was up a couple percent to down 5 or 6%, but it was a wild ride the way we got there. The first four and a half months of the year were up. Starting in May and June, we saw some weakness, and then really August and September were quite brutal. Just huge 100-point swings in the Dow every other day, and it was really quite painful. And there's a huge focus on the downgrade of the U.S. government by S&P, and a real focus on the U.S. Federal debt. And 2011. One of the surprises is that how well bonds did. I know I'm very surprised, and Bill Gross, who runs one of the largest funds out there, particularly bond-focused funds, he admitted halfway through the year, well, maybe three-quarters of the way, that he guessed it wrong. And so I think 2011 is going to be the big surprise. But that's the bonds, how well they did in 2011 is going to be the big surprise. But that's why we remain diversified, because my experience has shown in 21 years that the thing that you love the most, sometimes you're just darn wrong about. And so the thing that you hate the most, sometimes you're wrong about that as well. So it's really looking at the percentages, maybe weighting one over the other, and changing that allocation throughout the year. So you're probably wondering about 2012. Well, right here in my hands, I've got the 15 experts predict 2012, a little article. And big names, we're talking Goldman Sachs and UBS and, kind of every big name that you can think out there. And frankly, one article says that China's the best thing in the world, and the next one says China's going to be a problem. One says that the U.S. Is going to have great growth, and the next one says it's going to have poor growth. One saying bond's good, one's bad. And really, the answer is always unclear. This year is no different. I do believe that we're going to continue to have volatility, and one thing that I'm going to do is meet with clients to talk about whether or not some strategies need to be implemented in order to take advantage of that. But I am optimistic for 2012. I'm going to throw up a chart here, but we're going to see that the percentage of current assets that are in cash and cash equivalents has increased. And from a corporation point of view, that makes a lot of sense. I mean, when there's uncertainty, you're not sure how many widgets you're going to be able to sell or how many services you'll be able to provide. You want the best balance sheet that you can have. And I think the best recipients, when that cash gets converted back into research and development, gets back into the economy, I think that mid and small cap companies are going to be the ones that are going to be the kind of the first beneficiaries of that. 2012, I feel will be event driven, just like 2011 will. We're going to hear lots of stuff from Europe, and we're going to hear a lot about the debt, and of course this is an election year, so we're going to hear all about the election year politics, but I think we're also going to hear about China. That's going to come in here because it's had a huge growth. It's been one of the largest, kind of emerging into the developing markets, but it's faltering, and this could be the year where it kind of teeter-totters to the bad side. So that's something that I'm going to really watch out for. I'm going to throw up here on the chart that as it relates to volatility, here's a chart that we kind of forget about it, but most years have some kind of volatility. The bottom number is the intra-year kind of decline, and that does not mean that the year ended. the black number is actually what the year ended. So although there might have been a double-digit decline throughout the year and everyone kind of freaks out, it's not over until it's over. I'm here in Boulder. We got our Denver Broncos, and between the fourth quarter and overtime, the game's not over till the whistle blows. And so throughout the year, if we have some huge declines, we have to assess at that time, hey, wait a second, is this going to continue, or is this just one of those throughout the year declines that we still feel firm in our analysis that the market might be undervalued. Speaking of the market being undervalued, I don't hold much weight with forward price to earnings ratios, but I do like that not the forward, but the actual price to earnings ratio is low right now, particularly in comparison to like the 20-year average and what has historically been. So I'm kind of in the Warren Buffett camp that believes that this is a market that is undervalued, that the economy is actually getting better. It might not feel that, particularly if you're unemployed. I mean, we have an unemployment problem and we have a housing problem, but I'm kind of in that camp. I could sit here and go on and on and on, but I think that I've gotten my feelings out to you. That in general, I'm optimistic for 2012. I think that small and mid cap are probably kind of the styles that deserve closer attention. But you've got to, of course, do what's consistent with what your risk levels are and your particular goals, and work with your financial advisor, and hopefully that financial advisor is me. But if not, of course, everything I say here today is kind of general, so you can get a general feel for how I'm thinking. That's it for 2012. Mike Brady, Generosity Wealth Management. I do have these videos weekly, sometimes every other week, depending how busy I kind of get and if I'm able to get it out in time. I'm a full-service wealth management firm here in Boulder, although I have a number of clients in many different states. I named it Generosity Wealth Management because I truly believe that that people are trying to make the world a better place, and that includes making things better for themselves so that they are not a burden upon others in their own retirement, that they make things better for their family so that they can pass money on to their family or just provide for them, whether it's a college education, whether or not it's just to make their life a little bit easier, but also to make their community a better place, both local and global community. And so there's some generosity that each of us have inside us, and that's many of the thoughts that went into my company name of Generosity Wealth Management. 303-747-6455, www.generositywealth.com, and please stay tuned. I will have another video and another newsletter before you know it. You have a wonderful, wonderful day. Thank you. Bye-bye.